Aniruddha Sarkar with us now. He's CIO and Portfolio Manager at Quest Investment Advisors. Aniruddha, great to have you and your view on a day when there is a lot of concern and confusion. How are you looking at the events that we've seen in the last 24 hours or so? And I'll start with your view on the Israel-Iran escalation that we've seen. We've seen one side of the story. If there is a response from Iran, do you see the whole situation spiraling? And then what happens from an emerging market perspective?
Hi, good morning. So I think attuned. Am I audible?
Yes, yes, you are, Aniruddha. Go ahead.
Yeah. Hi. So I was saying over the last couple of years, I think, one thing which we have as investors, all of us been attuned to is, with the type of the geopolitical events which has been happening. And fortunately, what we are seeing in the markets, even as of today, if you see, markets don't react to that extent what they would have done in the past, purely because most of these conflicts have become very, I would say the impact on the economics has been much less compared to what they used to be in the past. Even if it happens, the impact does not last for long. Having said that, I think the biggest issue with the conflict which has just begun, Israel-Iran conflict, I think is all about oil. So I think that is one big factor which could drive world economies and markets, because oil prices over the last 1 year has been, I would say, much below what used to be earlier. But now with the conflict going up and Iran being a major kind of supplier in the market, I think you could see oil prices going up much higher from where we have been used to over the last 1 year. So oil price going up is going to be a major factor, especially for emerging country like India, which is a major importer of oil.
So from an Indian perspective, I mean, crude now back at 75, 76 is not something that has been penciled in for any of these companies, right? I mean, say when ONGC, bad news for everyone, economy, consumption, inflation, all of that goes out for a whack. Is your sense, Aniruddha, that this might not be a long-lasting trend? Because you've seen crude hover around the early 60s mark, Brent at least, for the better part of over a year.
Absolutely. I think, as I mentioned, that's the reason the markets are also not overreacting, for a simple reason that most of these conflicts have been very fast and very short-lived. I would say, except for the Ukraine-Russia war, which has been going on for ages, I think most of the other conflicts did not have much of an impact on any of the commodities or any of the economies, purely because it has been intense and very short-lived. Even for the matter of fact, if I see what news has come up over the night, I think Israel attack has been able to kind of, been very impactful, with one of the chiefs of Iran's the rebellion army being executed. So I think it could be short-lived, but yes, there will be a major kind of a retaliation. But yes, we'll have to wait and watch how things escalate. But oil prices, I think as long as we are below 80, 85, I think we are fine. Only once it crosses 85, that is wherein I think, we have to worry about.
Right. Aniruddha, you've been a buyer in terms of the broader markets. You've been vouching for them over the last couple of quarters. Taking into consideration the corrections that we are seeing currently, would you say buy on dips should be the strategy in terms of broader markets? And if so, which are the sectors that you would be looking at?
No, absolutely. I think, over the last couple of months, we have been buyers. We have been telling investors, ever since the decline in the market happened in January and Feb, the first 2 months of this year, we have been telling investors that, use this correction to buy. I think, we have been remaining invested as we stand. We are 95% invested with just around 5 to 6% of the cash in the portfolio. Having said that, I would say that definitely this is a market for investors to selectively pick sectors, selectively pick companies, because that is where the returns are going to be made. It's not going to be a broad-based market return over the next 1 year. It will be very specific to sectors, very specific to companies, and that is where I would say investors need to focus on. Just to give a hint, one space wherein we have been very bullish on is the whole industrials and the capex. And if I look at the data which has come out for FY25, I think the private capex has outpaced the government capex after a long time. And I think these are indicators that you need to bet on sectors, you need to bet on companies where growth is going to unfold and where growth is happening as we speak. Everything does not get impacted with the wars. There are sectors which are doing well, and that is where the focus is.
Aniruddha, this is Harsh also joining in. The first part of my question is, do you typically sit on a 5 to 6% cash, or would you be looking to deploy any part of that anytime quickly?
So on an average, I keep around 5% cash,
Right.
because my reasoning is that, if your remaining 95% can't act, then I think even that extra 5% deployment won't help. So 5% cash typically is what I keep, purely because if there are opportunities on days like this, you would want to go and buy something. And if you're fully invested, then you can't take that action. But yes, once you're fully deployed, or maybe around 97, 98% deployed, still I would always keep some cash. Having said that, I do take cash calls at times when things look overheated, when things look that you are not getting much investable ideas, you're finding almost everything expensive. I don't mind going up to 10, 12% cash also. Highest cash in my history I would have gone up to around is 18, 20%, but not beyond that. But yes, 5% cash is an average level.
Sure. And Aniruddha, if you are deploying today, what is it that you're deploying into?
See, I continue to bet on industrials and capex, and within that, energy and power is my biggest bet. Purely because if I look at the capex numbers, also if you break down the capex numbers, you would see out of the major capex which has happened, the biggest capex is happening in the energy and the power space. The whole energy and power space is one area where the highest capex has happened. And interestingly, if you look at the breakdown of the capex, it's been very broad-based this time around, unlike the earlier, I would say, the capex cycle, where it used to be focused on a few large companies. So I think this is one area where I would focus on. Domestic manufacturing of defense is very interesting, and I think we always find the defense stocks going up whenever we find any news of the war and the conflicts. But unfortunately, valuations is something which always keeps us on the back foot and wait for better levels to enter. But yes, defense stocks for a medium to long term is definitely something one should look at.
Seeing valuations in the comfort zone for you, Aniruddha. Interested to understand that, because there has been a fair bit of correction in certain pockets, and definitely not defense. If I look at, say, FMCG, if I look at auto, from their peak, there's been a fair bit of correction. Are you seeing pockets of value, even some select favorites in terms of mid cap and small cap?
Yeah, auto and auto anch is something I think, it has, I would say, showing some value, but I would say still, not something which will become a very big kind of a buy for me. FMCG, I'm still avoiding, purely because I think valuations, though they have corrected from the peak, but when I look at the broader market, so if I'm looking at valuations, I'll typically look at the price to earnings, the growth ratio, which is the PEG ratio. On a PEG ratio basis, I still find FMCG companies not giving me that comfort compared to many other, I would say, sectors out there. So though FMCG valuations have corrected from the peak, but on a PEG basis, they are not giving the comfort. When I talk about PEG, it's about getting comfort on the earnings growth. The earnings growth is still not giving you that comfort that you would want to bet on the FMCG. But within the consumption basket, I am more bullish on the urban consumption, because that is where all this tax benefits, the whole tax benefits which has come into play from April 1st, which is going to go into the hands of the taxpayers, which is the urban and semi-urban middle class. That is where I would say a lot of the low-ticket consumer discretionary items could see uptake, which includes your the two-wheelers, which could include eating out, the going out, the retail formats, which could include your hotels. So all these things I would say is something where I would believe, you could see the consumption growth being better than the FMCG basket.
So, Aniruddha, that's with regards to auto and auto anch. Let's look at the other side where, you've seen banks which have been slightly cooling off for the last couple of trading sessions. And this is from a technical perspective now that they are away from that overbought zone. Expectation is there could be buying that could emerge on that front. Fundamental perspective, would you say it's best to start looking at the mid-cap and small-cap PSU banks or private banks?
See, overall on banks, I'm a bit underweight purely for a factor that now with the rate cycle going down, I think, you will find a bit of a compression on the names. And last 1 year, the private banks have outperformed the PSU banks. So hence, if you ask me between private and PSU, definitely private banks look more expensive than the PSU banks as we stand. Having said that, I typically don't bet into the mid-sized PSU banks. And to be honest, the ideal exposure for any investor to take a bet on PSU banks should be buying the PSU bank ETF because that gives you an exposure to a basket of the PSU banks without taking any direct call on any single PSU bank because as we know, accidents do happen in PSU banks. So having said that, I would say valuation wise, I find the PSU banks much better than the private banks. But yes, again, it's a big factor that overall banking, I'm not very bullish because I think the NIM contraction is something which is here to be there. The other thing is the lending growth, which is still to pick up. So unless the lending growth picks up and the rate cycle is going down, NIM contraction. So all these are, I would say, the headwinds which the banks would see in the, I would say, the next couple of quarters.
Understand, Aniruddha, in that whole BFSI space, and you talked about PSU banks and private banks, are NBFCs looking like they are in a sweet spot? Because all your loan quality, asset quality, and especially microfinance asset quality concerns are beginning to wane.
Yeah, I think if you ask me compared to the banks, I would put my hand on I would put my investments on the NBFCs because I think, as you rightly mentioned, I think the pain is behind us for the sector. And most of the NPAs or I would say the worry on the microfinance space, which was there, I think that is now behind us. Valuations are also not very expensive over there, and I would say they are in a better shape. And within NBFCs, I would say those having exposure to housing finance could also be kind of the good bet. So I would say overall between banks and NBFCs, more bullish on the NBFCs. Within BFSI, I'm quite bullish on the whole equity market play, which includes your platform businesses, which includes your exchanges, which includes your asset management companies, wealth management companies. Because I think this is one space wherein if we are talking about equity markets doing well, if we're talking about household savings moving to equity market, I think they will continue to show much higher growth compared to your banks and NBFCs.
Aniruddha, where within that pocket are you finding interest? Is it the exchanges? Because we've seen substantial run up in terms of the way exchanges are currently valued, both unlisted as well as listed. So curious to know that specifically. But even outside of that, what's the preference within that pocket?
Yeah, absolutely. As you mentioned, Harsh, that I think exchanges they have moved up way beyond my wildest expectations, and thankfully, I have like the one exchange as among my top 10 holdings in the portfolio, and that has done exceptionally well. But having said that, at this level, I would be a bit cautious to enter into the exchanges because they have had a very sharp run up, as you rightly mentioned, in the last couple of quarters. Having said that, I would say asset management companies is where I find good value and also with many of the IPOs of asset management companies happening, I think you could see good interest over that space. The other space where I find good interest is platforms, which are the intermediaries between the different, I would say, whether you talk about investors or AMCs. Platform businesses are also good value. So basically, my bet would be on asset management companies and on platform businesses.
So do you like platform businesses or not?
Yeah, I like platform businesses.
Okay, even as competition heats up, even as cash burn will continue, even as there's regulatory issues with the quality of dark stores, etc., all of that is not concerning you, and valuations, of course.
See, so when I'm talking about platform businesses, I was talking about platform businesses on the capital market, like the capex and the
So not quick commerce. Okay.
I'll come to that. I'm happy to answer that because that happens to be among my the top 5 holding. So when it comes to the quick commerce, I think whatever news we had over the last couple of weeks with the different government checks and the food inspections, I think this is something which makes them much better in the sense that they would be required to take care of the quality issues. Broadly, the quick commerce is something which is here to stay. It has changed the behavior of the end consumers like you and me. We are not going to go back to the old thing of taking your car out and going and doing a shopping or going to a big bazaar on a weekend and doing a shopping. I think this is the way whole of India is getting transformed. And as of today, if I see the quick commerce business, its share in the overall, the consumption basket is the low single digits, which means it has a long kind of a runway to expand.
Aniruddha, taking, the last report that we saw from one of the brokerage houses yesterday was in terms of the capex. Private capex is at a high as compared to government, and that seems to be a key positive. The government was waiting for private guys to come in and spend. Would you say this would be a good time to then bet on infra companies? And if so, which segment would you prefer?
Yeah, absolutely. I know, as I mentioned initially, I think this is the first time after a long time that we are seeing the private capex actually outpacing the government capex in absolute terms. In percentage growth, it is still the government capex which has grown much higher compared to the private capex on a Y-on-Y basis. But in absolute terms, private capex has picked up. Now, the good part is that most of the private capex which has happened over the last 1 year, I would say a large part of it has come from the internal cash flows. Hence, the lending growth has not been high. But the good part is that the cash flow as a percentage of the capex has gone down, which means now as more and more capex will happen, you will see the bank lending also going up, which once that happens, you will see a good uptake in the banks. But we are yet to see when that happens. So as of now, I would say capex definitely is happening and it is growing. Talking about the sectors, I would say if you look at the breakup of the sectors where the capex is happening, the highest is in the power and the energy space, X of Reliance. So X of Reliance, the highest capex happening in the power and the energy space. And that's the reason I'm betting the most over there, because that is one area where I would say a lot of growth is visible. So apart from that, the good part of this capex, if you look at the report also, it talks about a very broad-based capex, unlike the last capex cycle. So this time around, the capex has happened across multiple sectors, whether it is healthcare, whether it is energy, power, the roads, railways, across board. So I would say it's happening across, but my bet is on the power and the energy.
Okay, thank you for that. Bet on power and energy in terms of capex. Interesting. Aniruddha, a pleasure to speak with you as always. Thank you for coming in today.